Money at Work, continuing financial education series brought to you by Millionaire Mindset Life. Today's video and today's episode centers around helping you understand how market losses can derail your wealth building journey. In the world of personal finance and wealth building, the allure of fast money and wealth through investing can be incredibly tempting. After all, it's portrayed as one of the most surefire paths to financial success and freedom, with the promise of compounding gains and a comfortable retirement. But amidst all those promises, there lurks a never-ending financial threat that has wreaked havoc on even the most well-laid financial plans, and that's market losses. These inevitable downturns can devastate a person's ability to build wealth, save for retirement, or just simply get ahead financially. Let's examine how market losses can derail your wealth building journey. Let's provide a historical perspective so you understand, and then emphasize the importance, once again, of safe money principles. There are two big impacts of market losses. Number one is that time is money, and losses steal both. Time is a precious resource when it comes to building wealth. Market losses not only drain your financial resources, but they also rob you of something even more valuable, which is your time. When your investments take a hit, it's not just the money that you lose, it's the time that you can never get back. The longer it takes to recover from losses, the harder it becomes to achieve your financial goals. And the second big impact is the emotional toll. Market losses are not just financial setbacks. They also take a toll on your emotional well-being. Watching your hard-earned money disappear can lead to stress, anxiety, and maybe even panic. These emotional reactions can cloud your judgment and lead to even more further impulsive decisions, which is exasperating the impact of the losses. Now we want to just learn from the lessons from the past. This is an historical perspective, lessons from the past. To truly understand the significance of market losses, we must look to history. Throughout the years, financial markets have experienced a roller coaster of ups and downs. We're going to go through some notable events, including, I'm going to start off with the Great Depression, 1929. The stock market crash of 1929 is the most iconic event in financial history. It marked the beginning of the Great Depression, which was a period of widespread economic hardship that lasted for years. The crash was preceded by a speculative bubble in the stock market, and when it burst, it led to absolutely devastating economic downturn. It took nearly a decade for the market to recover fully, highlighting the long-lasting consequences of these severe market losses. Then next up is Black Monday, 1987. On October 19th, 1987, a day infamously known as Black Monday, the stock market experienced one of the most severe single-day crashes in history. The Dow Jones Industrial Average plummeted by astonishing 22%, wiping out billions of dollars in just a matter of hours. The sudden and unprecedented crash sent shockwaves through the financial world. Investors who were unprepared for such a massive downturn faced significant losses. And then the dot-com bubble burst of 2000. The late 1990s saw the rise of the dot-com bubble, driven by speculation in internet-related stocks. By early 2000, the bubble had burst, causing the NASDAQ Composite Index to plummet. Many investors, drawn by the promise of quick riches, lost substantial amounts of money. The dot-com bubble burst demonstrated the dangers of investing in speculative assets without considering fundamentals. It took, once again, several years to recover. The Great Recession of 2008, the housing market crash and the ensuing global financial crisis in 2008 triggered one of the most significant economic downturns since the Great Depression. The crisis was fueled by the collapse of the subprime mortgage market and subsequent banking crisis. The Great Recession had far-reaching consequences, including global recession. Investors experienced significant portfolio declines, with some seeing their retirement savings severely affected. And then the most recent, the COVID-19 pandemic of 2020. The onset of the COVID-19 pandemic in early 2020 led to a rapid and sharp market downturn. As governments imposed lockdowns and economic activity slowed, stock markets around the world experienced significant declines. The pandemic demonstrated the unpredictability of what we call black swan events and their potential to disrupt financial markets. We need to recognize various forms of market risk. Market risk encompasses a spectrum of potential threats to your investments and your financial well-being. Being able to recognize and understand these forms of risk is crucial for making an informed decision and protecting your assets. Here are the primary forms of market risk that you need to understand. First is a flash crash. Flash crashes are sudden and extreme price declines that occur within a very short period of time, often measured in minutes or even seconds. These events are typically characterized by a swift and dramatic drop in asset prices. Flash crashes can be triggered by various factors, including technical glitches in trading systems, high-frequency trading algorithms gone awry, or sudden and unexpected events. Investors caught in flash crashes may experience substantial losses when they cannot exit their positions quickly enough. And then market corrections. Corrections refer to market declines of at least 10% from their recent peaks. While less severe than crashes, corrections are still a significant event, and they can shake investor confidence. Corrections can start from a variety of factors, including economic slowdowns, geopolitical tensions, or just a shift in investor sentiment. Corrections are a natural part of market cycles and can provide huge buying opportunities for long-term investors. What about crashes? Crashes are more severe than corrections and involve a rapid and substantial decline in market values, often exceeding 20% in loss. Crashes can result in significant financial losses for investors. Crashes can be triggered by a range of factors such as financial crisis, speculative bubbles bursting, or once again, those sudden economic shocks. They're characterized by panic selling and a rapid erosion of market confidence. Crashes can have long-lasting effects on investor portfolios, leading once again to steep losses. And then bear markets. Bear markets are extended periods of declining market values, typically characterized by a drop of 20% or more from the recent highs. These downturns can last for months or even years. Bear markets often coincide with economic recessions, high unemployment, or just terrible economic conditions. They erode investor wealth and investor confidence. Bear markets can be financially and emotionally challenging. Investors see their portfolios shrink significantly, and the recovery period can be lengthy. And then the black swan event. Black swan events are very unpredictable and rare occurrences that have severe and widespread impact on markets. They are events that by nature are unforeseeable and disruptive. The COVID-19 pandemic in 2020 is a prime example of a black swan event. Other historical black swan events include September 11, 2001 terrorist attacks and the collapse of Lehman Brothers in 2008. Black swan events can trigger rapid and severe market declines, catch investors off guard, and create widespread economic turmoil. We need to understand and implement the importance of safe money principles. Investing is a powerful tool for building wealth and achieving your financial goals, but it's equally crucial to balance the potential rewards of investing with the need for safety and risk management. Safe money principles can provide a sturdy foundation for your financial journey, helping you weather these storms that the financial markets often bring. You need to diversify. Diversification involves spreading your investments across various asset classes, industries, or geographic regions. By doing so, you can reduce the risks associated with a single investment. Diversification can help mitigate the impact of losses. As one asset class underperforms or experiences a downturn, others may perform better. Diversification can help you avoid devastating consequences of having all your eggs in one basket. We also need to establish and uphold an emergency fund. An emergency fund is dedicated savings with enough funds to cover 3 to 6 months worth of living expenses. An emergency fund is your first line of defense against financial crisis. It prevents you from needing to liquidate investments at the worst times, potentially locking in losses. Instead, you can rely on your emergency fund to cover essential expenses, giving you time to navigate the challenges without jeopardizing your long-term financial goals. And as we talked about earlier, risk management. Understanding risk tolerance is a critical aspect of risk management. It involves assessing your willingness and ability to withstand losses in your investment portfolio. Based on your risk tolerance, you can choose investments that align with your comfort level. Risk management is about finding the right balance between seeking returns and preserving capital. Overexposing yourself in investments that can cause severe financial harm during market downturns can be detrimental to your overall and long-term wealth building journey. And professional guidance. This is important. Consulting a financial advisor can help provide you with help and guidance in developing and maintaining an appropriate investment strategy. A financial advisor can assess your financial goals, risk tolerance, and time horizon and help you create a diversified portfolio tailored towards your needs. While you can educate yourself about investing, advisors bring a wealth of knowledge and experience to the table. They can help you stay disciplined during the market volatility, and they also make informed decisions that align once again with your long-term objectives. Remember, market losses are an ever-present threat to your financial well-being, capable of derailing your wealth-building journey, retirement plans, and financial aspirations. By recognizing the historical context, understanding different forms of market risk, and adhering to safe money principles, you can better prepare yourself to weather these storms that the financial markets inevitably bring. Remember, building wealth is a marathon. It's not a sprint, and the ability to persevere through market losses can ultimately lead you to financial success versus financial ruin. Millionaire Mindset Life, stretch your thinking, create your vision, and achieve.